Let's have a quick conversation about how to switch credit card processors this year. Switching credit card processors is not an easy task, but it also is not a difficult task. The only thing is you need to be methodical. You got to have a strategy. You got to have an approach, and you got to really go through. You got to really follow through in terms of executing your vision. Okay. So here are the facts I want you to think about. If you are looking to change payment processors or switch payment providers, you got to really ask yourself, what are you looking for? And the big question is, why do you want to change in the first place? In other words, why are you leaving your current payment processor? Is it because of cost? Is it because of customer service? Is it because of the functionalities that the virtual terminal doesn't have? So you got to really have a clear idea about the reasons why you are dissatisfied currently. Because the last thing you want is to actually repeat the same mistake from like the same mistake you had now with a new provider. Okay, and one thing for sure, navigating the payments infrastructure and the world of online payment processing can be really difficult. And but that's why you got to have a method. You got to have a methodology to really follow through. One thing for sure, when you are thinking about accepting credit card payments, it's about actually offering, let's say, a facility to your customers to actually pay you, to actually also collect payments for you also. Okay, and so whether you go from Square to Stripe to QuickBooks to HealthSim to a Clover to all those like all that constellation of credit card payment processors, you got to really ask yourself what you're after, and don't forget the integration. You want your payment processor, at least the solution that they have, you want that solution to integrate with your current tech stack, because the last thing you want is to actually have a payment processor that's really a standalone tool, and you can't really integrate it with your current tech tools. And now you have to open gazillions of windows to actually make all those apps talk to each other. So integration is important. Of course, cost is important. Customer service is important, but so is integration capability, as well as, and don't forget this, as well as PCI compliance. You want your payment processor, the new one that you're getting, to be PCI compliant, PCI DSS. So let me give you those steps here. When you think about switching credit card processors, the first thing you want to do is to actually check your contract. I want you to go back and really read your contract. Before you get excited about savings on your payment processing fees, check your contract with your current merchant services provider. You may have to give notice, and there may be a penalty or a cancellation fee involved, which is usually around 200 all the way to 300, 500 sometimes, even though we have seen cases where the early termination fee was actually $1,000. Okay, so sometimes and sometimes this ETF, the early termination fee, can be hidden in the fine print. So it's important to really have a clear idea about what you currently have if you want to go to something else. Okay, so you want to really dig into those T's and C's, the terms and conditions. Okay, most payment processors, including banks, will have you sign a 3-year contract term for payment processing services. So depending on the processor, there may also be a monthly software fee for, let's say, a specific payment processing tool, but this will not apply to all merchants. You may also need to contact your merchant services provider to confirm the details of your agreement with them before switching, and request everything in writing if possible. The last thing you want is, again, you do not want to have some kind of a misunderstanding. And so that's pretty good. And by the way, let me talk to you quickly about the Canadian Code of Conduct. If for any reason you are in Canada, or you have operations, you have clients in Canada, you are in the States, but you have clients in Canada, basically make sure you read the Canadian Code of Conduct for the credit card and debit card industry on the Government of Canada's website. Okay, you may be able to opt out of your payment processing services contract early if you haven't been notified of a fee increase without 90 days notice. It has to be 90 days, okay? At least minimum. At least 90 days. Or if your effective processing rate per transaction hasn't been communicated on your merchant statement, you could actually get out. There are some limitations on auto renew agreements to make sure that you want to check the contract with your current processor against the code of conduct. Okay, very important. So that's really important for you to really have a clear idea about your next move. So if you want to switch credit card processors, the first thing you want to do is check your contract. You want to dig into those T's and C's, right? Now, step number 2, you want to get your information ready and sign up to your new provider. Of course, you have already done the due diligence and you're comfortable with the new provider. So as you prepare to change processors, there are some essential pieces of information that you will need to provide to make sure your business dealings are legal and legitimate. The two L, okay, the two L's, if you will, legal and legitimate. You may not have needed all this info when you signed up for a business account on a different platform, but some credit card processing companies require further information to reduce their risk, especially if there are certain industries or regions that they don't offer a payment processing services in. It's all about risk mitigation. It's all about the merchant, the payment processors covering their asses. Okay, it's all about really covering the butt. So risk mitigation really can go a long way here. So basically, they're asking you for your business information. So have this in mind: your legal and operating business names, your business addresses, and the type of registration you hold, whether it's a sole proprietorship, a partnership, a corporation, or nonprofit. Or if it's a DBA, just make sure that you are ready to provide that info too. You also need your tax ID. It can be your social security number or your EIN, your employer identification number, your registration date, business phone number, and registered email. Also, you have the industry and product information. So to verify your legitimacy, there may be more information needed about the products and services you provide and the industry that you operate in. Some companies, some payment companies have a tiered pricing system that can offer you a lower rates per transaction. So again, don't be afraid to share some financial details such as your monthly card payment value and average transaction size. Okay, and also your personal information. So all payment processors require personal information by law, and it's called something called KYC, Know Your Customer, and some processors have restrictions in certain regions. So get ready to share your name, birthday, email, and phone number. And if you don't have a tax ID, you'll need your social security number or social insurance number if you're in Canada. You may also need to share your home address and some details about your ownership stake, if any. Step number 2A, you want to keep the same bank account, okay? Although you will be switching the company you use to process payments, you won't have to do the same with your account at the bank you currently use to collect payment. Keep this information handy though, as you will need to send this to your new payments processor. Very important. So if you want to switch credit card processors this year, the third step you want to really follow is to get new equipment. Now, skip this payment if you only take online payments. If you have a Shopify store, if you have a BigCommerce store, a WooCommerce store, an Etsy store, or Amazon or Etsy or eBay, okay? Now, if you are primarily processing payments online, this may not apply to you, but if your business accepts in-person payments, you will need to look into alternatives or equivalent for your current POS systems that are actually compatible with the payment processing company you are basically switching to. That's very important from a scalability point of view. The thing is that you first want to ditch the monthly recurring payments for rentals. So this is you want to go for a payments processor that really has no monthly rent when it comes to equipment. So once you purchase devices from the provider, you are basically owning the whole thing outright. Okay, that's really important, and you want to be able to accept in-person payments, also called card present, with all major credit cards and debit cards in multiple currencies. Now, there are many drawbacks to leasing equipment, but in general, leases are harder to cancel, and you end up paying more in the long run. So our recommendation is that you rip the band-aid off and purchase your equipment outright. So this is really important, especially if you are looking for a terminal or a card reader. So you have possibilities. You have the possibility between having a virtual terminal. In other words, you have a virtual terminal that actually integrates a point of sale system, inventory management platform, payment tools, and receipt printer. Or you can have a card reader. So a card reader is the entry level device for for small businesses looking to accept card payments. Okay, so it's one of those things where you have to see what works for you. My bottom line here is that buying new equipment can seem scary, but the sunk cost pays itself off very quickly, as you'll hopefully be saving enough on your processing fees with your new payments provider to repay this in a couple of months or less. So this is really important for you to really consider this year. So if you think about switching credit card processors this year, I want you to really think about using both providers at the same time. It's all about trying the new provider while keeping the old one. That way you are not risking anything, okay? So after you have signed up and ordered new equipment, you want to make sure that your payments infrastructure is intact and you can still accept payments without any downtime. So some processors take some time to evaluate your application and verify all the info that you have provided. So what you want to do here is that you want to really make sure that you're covering your butt on both sides. So instead of canceling the contract right away with the existing processor, take time to actually evaluate both. Okay, who knows? Maybe you might realize that the new one is not really that different from the old one, and or it could be worse. Okay, so you want to take the time to really make sure that you're having a good strategy. One thing for sure, when you think about having both providers at the same time, this is actually a low risk affair because using both providers at the same time is actually allowed and encouraged, especially when switching to a credit card processor that doesn't have a monthly fee or a contract. Okay, this ensures that you take the lowest risk when trying out a new processor, and if you decide to switch back, you can do so without minimal fuss. This is one of those things, again, you are covering your ass on both ends. And so most small businesses who want to make the switch use actually both providers for a few months so they can also compare and contrast merchant statements and calculate if they are actually saving on their credit card processing fees. Because see, the whole thing is that when you're switching, this is primarily a cash inflow, cash outflow process, right? You want to make sure you're saving money, but most importantly, you want to make sure that you are also providing the kind of customer service that you want to provide to your clients, so that they can actually order more from you. You can actually increase your CX, your client experience. So that's really important from a scalability point of view. That's really important, especially in the long run. If you are thinking about switching credit card processors this year, you want to check your first statement to see if you are saving on transaction fees. Okay, so the steps, again, step number one, check your contract. Number two, get your information ready. Number three, you want to get new equipment. Number four, you want to use both providers at the same time. And the last step here is to check your first statement. So is your new processor charging you a higher or lower processing fee per transaction? And are you saving money overall on credit card processing fees? So you likely have done your research before switching, but depending on transaction and card type, you may be paying higher fees overall than your previous provider. Okay, it's one of those things where you have to make sure that you are actually winning. You're actually winning the fee game. You're actually saving money. So if you accept payments online, be sure to check your current and new processor's rate, because some may have a different, usually higher rate to process online payments, because online payments are actually card not present payments. Okay, and so international transactions can also sometimes cost more to process per transaction than local payment methods, and card brand and tap matters. So keep this in mind when analyzing your merchant statements. Okay, you got to really have a holistic view here. And I also want you to think about back billing. So depending on the processor, your first statement may contain perceived lower processing fees, but you'll be back billed in your second statement onwards for these lower premiums. If you are using two processors in conjunction, you may be able to spot this, and you can spot this on your second statement. So proceed with caution when researching which processor to switch to, and make sure they are completely transparent with their pricing. Okay, sometimes they're not, but yet this is actually a part of the risk. I mean, not a risk, but it's one of those things where you have to make sure you're getting the best deal. And one thing you also want to make sure is that you have to maybe do some research about what kind of processors your rivals are using. Because see, the thing is that if a rival, if a processor is already working with your rivals, chances are they know your industry in and out, and that's what you want. You want a processor who understands your industry in and out and can really work with you. And that, yeah, so just expand your horizon. So if you think about switching credit card processors, let me give you a few tactics here. Here is our recommendation for switching payment processor. So you want to pay attention to pricing. You want to pay attention to customer service. I think I've said this before, but you want to pay attention to integration. You want to pay attention to the local currencies versus international currencies. Okay, so navigating and managing your business's payment infrastructure for online payments and in-person transactions can be a complicated matter, especially if you have multiple sales channels and accept multiple payment types. Okay, I mean you have like if you accept credit cards, debit cards, ACH, mobile payments, and so on and so forth. What you want to have here, you want to have a service that gives you, let's say, an end-to-end payments facility, whether you are looking for a payment gateway or a full-on payments processor. So if your business accepts payments, especially through credit card transactions, basically you want to make sure you have the solution that can really help you out. And also pay attention to pricing. I mean, it's good to go to a new processor, but what about pricing? Do you want to have a interchange plus pricing, or you want to have something else? Okay, it's one of those things where you also have to pay attention to hidden fees. It's one of those things where the last thing you want when you analyze when you compare and contrast credit card statement is that you are actually you end up paying way more because and way more in processing fees. Because see, the thing is that those credit card payments providers, they actually hide the fees, so you have a lot of hidden fees, and before you know it, you just paying way more than you were paying before. So be very careful and do the math. Let's say line by line. Do the math in granularity, line by line. You want to analyze, let's say, expense items that are similar, so you can see whether or not you're saving money or not. This will help you in the long run because depending on where you are at, you will see whether or not you're getting the best deal. So this is important. So if you're in the States, or you are in Canada, or you are in Europe, or you are in Asia, or you're in Africa, or you have clients in Latin America, this will make a big difference. So in conclusion to this conversation, I spoke to you about how to switch credit card processors. I gave you the facts, the steps, the tactics, and our conclusion. Thank you so much. God bless you. I'll see you next time. Until then, remember, stay marvelous.